My name is Klausa Topi, and I'm a finance student at Salem University. My advisor is Sanjay Jain, professor from finance department at Salem University. Today, I'll be presenting a study of semi-strong form of market efficiency with active and passive portfolio strategies through Bloomberg terminals. So just to walk you a little bit about my presentation, I'll be going over some topics of discussion, proposed hypothesis, data analysis, portfolio performance, results, and conclusion. So I'll give a definition of market efficiency and semi-strong form of market efficiency, which is the form that I've decided to use in order to do this analysis. And then I'll go ahead and analyze and compare the both portfolios over a period of 12 weeks. And at the end, we'll see if we are able to define if market is efficient and how these affect the economy. So, what is market efficiency? Market efficiency provides to investors and market participants with all the available and same information and prices. So, market efficiency kind of gives an estimate of the investment value and gives relevant information about the intrinsic value of the assets. Market efficiency also has the ability to incorporate data to maximize the opportunities of traders and investors to kind of have so everyone has the same opportunities. This way, investors and traders won't be really able to have a higher return than the average market return. And there are three forms of market efficiency. So it's weak, semi-strong, and strong form of market efficiency. The weak form reflects the prices and all the historical prices and available information. And semi-strong form of market efficiency reflects all available public prices and information as well as historical prices and information. And then strong form of market efficiency reflects both publicly and privately price and information relevant. So, how market efficiency affects capital markets? So, market efficiency in an economy where market is efficient, market prices kind of like help to determine which companies obtain capital. And if markets are inefficient, then these funds must be misdirected and misread. However, market efficiency is also an important element to financial managers. Is kind of give them a better understanding of how the market is performing, the stock performance, company's performance, and kind of like helps them contribute even more in the development of the economies. So there are two forms of investing: active and passive investing. Some are actively managed portfolios and some others are managed index funds. So active investing kind of requires other associated costs with it, transaction cost, research cost, hire portfolio money managers, financial advisors, investment analysts, and more. While passive investing kind of like eliminates and minimizes this cost and reflects the returns of the market. So I've decided to create two portfolios, passive and active portfolio with 20 stocks each and follow them in a period of 12 weeks to see kind of like how they would perform and to try the market if it's inefficient or if it's not efficient and to kind of give a better understanding of these effects in our economy. So proposed hypothesis, I've decided to say that market can be outperformed, market is inefficient, active portfolio has the highest return versus passive portfolio has the highest return. So to start off with my active portfolio stock analysis, I've decided to put the 20 stocks and I did an extensive analysis of each stock in order to kind of like, decide where to invest and where not to invest. I followed the PE ratio, which kind of like shows us as investors like what to expect from the earnings and if it's higher earnings or lower earnings. And then we have beta, dividend yield, debt to equity, market cap, and return to equity, which also it's also another element which shows how well the company is performing, how well the company is managing its capital, but also its investors. And then we have industry research and history performance, which are both very important in order to kind of like give a better understanding of how the companies and stock is performing prior and maybe like in the last years, in the last decades, and what are kind of like the um, the expectations about the future. And the same goes for the industry research to see kind of like what industry is powerful, what industry stocks are performing well. So kind of that helped me to decide among these 20 stocks. And here I've attached an Excel spreadsheet of a detailed analysis of the debt equity, P ratio, ROE, beta, and more. And here's my Bloomberg Terminals active portfolio of 20 stocks. So here's the active portfolio allocation. I've decided to, or I tried to do it as diversified as possible. I included a fixed security, and then I included other sectors and industries such as energy, finance, healthcare, technology, and more. I've put an around 300,000 of value to this portfolio to begin. And here's like a detailed allocation of my 20 stocks for the active portfolio. So this is the industry, the date that I've opened it from January 17th till April 4th. And here's the total market to total value of each stock, and the total that I've invested to start off. Here's the active portfolio weekly analysis. I followed this portfolio every week to kind of see their returns and kind of like help me decide which stock one I want to trade, where should I buy, where should I sell, and what other transactions should I do in order to try to maximize the return as much as possible. And at the end, we have the portfolio value throughout the weeks until the week of April 4th. And then here we have the performance of the active portfolio. We have a return of 6.8% from January 17th to April 4th. We can see that there are ups and downs, and we can see that around end of March, we have an increased growth of the graph and the return. Another element that I want to mention is the transaction costs and other expenses. There are transaction costs, as I mentioned earlier. When it comes to active portfolio, we have brokers fees, trade commission, and we have money commission to money managers, such as advisory fees. We have expenses related to the industry research, the data analysis, the trading platforms, and more. Here's a little spreadsheet where it shows my risk of 24.28%, and the optimization task is to minimize the risk with 20% turnover. Here are the stocks that I decided to do trading, to sell and to buy. I did 2 number of buys and 6 number of sells. And here are the costs. Here are the costs that are relevant to this investing. I included the broker's fees as 1.5%. I've included trade commission. I've included the advisor commission around 0.95% and research expenses, which I gave an estimate of $10,000, but it could also be more. And after these costs that calculated, we end up with the new return of the active portfolio. Then we go ahead and see the passive portfolio allocation, which again, I tried to do as diversified as possible. I kind of like did energy, finance, similar industries in such as I did in the active portfolio, and I invested the same amount of money, around 300,000, to kind of like see better the difference and to compare it better. Here's detailed allocation of my passive portfolio again. And here's the passive portfolio weekly analysis, which I did not do any transactions or any other movements around because I wanted to see kind of like, what was the market's return, and to see the passive portfolio in terms of market return. And I did not do any extensive analysis nor to pick the stocks either. Passive portfolio performance, we have a return of 2.69%. We can see that it also has ups and downs, and a major down in end of April, beginning of March. And then we have the results and comparisons, the both portfolios. The white line is the active portfolio, and the yellow line or orange line is passive portfolio. We can see that active portfolio has a marginal better return than passive portfolio, and the performance difference of active portfolio is higher, so it's positive. But also we have to compare these two portfolios with the market index, S&P 500. So this is the active portfolio versus SPX, which we can clearly see that they have very similar and closely returns to the market. And again, the same thing happens with passive portfolio versus SPX, with which they have closely returns. Um, However, in the active portfolio, we have a positive excess return in the first half and then negative excess return in the second half, which kind of like not does not give us a definite answer or a decision. And then in the passive portfolio, we have constantly negative excess return. But if we see the big picture, both portfolios have similar return with the market index. And lastly, the conclusion. I would say that I reject the hypothesis that markets are inefficient because there's no statistically significant results to tell us otherwise. Active management gives higher excess returns, as we saw in the graph, and also has a marginally better um, return, or is marginally better than passive portfolio. However, they both have similar results in terms comparing to market index, and there's no significant benefit to tell us that active investing is better, because to be better, there should be a significant high amount of net return in order to tell us what in order to return in order to tell us that this is a superior investment. And I conclude the market are efficient. However, I would recommend that more research should be done in order to kind of like give a better understanding of how these active and passive investing works, and to give a better how to make a better decision if active is the beneficial or passive is the beneficial. And I would also want to add that there is financial stability. Very informative prices kind of like promote economic growth. And I'd say that a truly efficient market where consistently grows into more information available, and the quantity kind of like eliminates the opportunities of arbitrage and above market returns. So, and I also want to add that market efficiency, or like the efficiency in the capital markets, is an important characteristic to kind of see how well functioning, and kind of reflect how well functioning financial systems are. And thank you so much